Oh, hi everybody. A little trouble with that unmute button there. I'm Allison Christensen. I am from the Moving to Work office at HUD. We're all good friends now after all these webinars we've been having on the asset building cohort. And today I think is going to be a really great opportunity from us all to hear from each other. We're going to be talking about the mechanics of the opt-out savings account program option of the asset building cohort. I know many of the agencies here are right in the middle of your implementation. We've had some MTW supplements that are coming in, so that's been great to see. If you're not there yet with MTW supplement, don't worry. But what we hope to accomplish today is really give you all an opportunity to talk to each other about some of the ideas and lessons learned you're having and getting started forming the program. We'll have some experts from CF, and they're going to be giving you some content and suggestions as well. We'll also be going over some of those key points of the policies that you've heard about at past webinars. So again, our goal is to give you all the most flexibility in designing and a savings account program that is going to work best for your community, while still bringing you all together in a way that is able to be evaluated by our independent third-party evaluator. So it's a challenge. We know you guys all have specific ideas, and we have been having some individual conversations with all of you about if you could be a little bit more flexible here or bring a couple of additional households on here. We really appreciate just your willingness to talk with us and to brainstorm solutions to some of these issues. So thanks in advance for all of that. And we just really appreciate you being here. And I think this is going to be a great session. We have some cool interactive features that we'll be using for you all to interact with each other and interact with the presenters. And with that, I will.
Thank you so much, Allison. Really appreciate that introduction. And thank you to the entire Moving to Work office for making this event possible. I think it's something that I'm really excited about because for the first time, the cohort, you as members of the cohort will become resources for each other, even more than you have been so far. Our aim today is really to start a conversation among all of us so that we can learn from each other, generate ideas with each other's help, and really start to roll up our sleeves on making this opt-out savings account program happen. So you just heard from Allison Christensen at the Moving to Work office, and I'm Ben Miller. I'm from ICF, and I'm here with my colleague Johanna Barrero. Both of us have about 20 years of experience working in economic and community development generally, but also specifically in the area of asset building. Johanna and I have worked on IDA programs, individual development account programs, which have some similarity, not the same thing as this program, but definitely relevant. Financial education, financial coaching, and other types of personal financial management interventions and resources. So really pleased to be here with everybody. Next slide. I mentioned, and Allison alluded to, how we're going to start to roll up our sleeves on this call. We have a resource called Mural, and we'll be doing actually more than half of our session today in Mural, which is a virtual whiteboard. It's almost, as you'll see when we get into Mural, it's like being in a conference room together with a whiteboard that we can all draw on and contribute ideas to. So in a few minutes, we're going to go and I'll show you how Mural works. You'll get a chance to practice those skills, and we'll be returning to Mural throughout the session today to brainstorm, to prioritize, to get some ideas out on the table. We also will hear from Johanna on the opt-out savings account program characteristics. We'll review some of those critical requirements and critical elements of the program so that those are always guiding our work in how we implement the programs. We'll talk about account types. That's a topic that really helps us get into details that each of you will need to think through as you design your programs. We'll talk about securing additional funds, which is an option that all of you have for your programs. We will talk about planning and program implementation. And that's when we'll get into Mural and really start working intensively to figure out, to get this program operating and to keep it operating, who needs to do what resources will those team members need to play those roles, and so on. And we'll start to wrap up with a look at resources that can really supplement your opt-out savings account program in the area of financial education and goal setting and helping people to get banked, uh, and helping people to uh, build habits and really use their savings effectively to meet their own goals. And we do have time for questions and answers at the end of the program today. So please do set those aside, or better yet, contribute those in the Q&A box. So we'll have those queued up for the Q&A session.
All right, great. So let's jump right into the specifics of the MTW expansion opt-out savings account program. All right, so the MTW opt-out savings program seeks to increase the number of households that have bank accounts. It also has the goal of encouraging the growth of savings accounts and household savings and strengthening household stability through asset building. So note that agencies can encourage the growth of savings accounts and household savings, not only through regular deposits, which we will talk about in this presentation, but also by encouraging households to build a rainy day fund, an emergency fund, by using messages that really resonate with those residents. You are all likely familiar with these goals of the program, but we wanted to start here so that um, you know you keep all of those three goals in mind, as it is very easy to become focused on one of them and forget about the other two. All right, so let's take a look at the program requirements. Through the opt-out savings program, PHAs can deposit a set amount of funds from HCV housing assistance payments or operating funds each month into an escrow style account for the benefit of assisted households. We'll talk about all of these components in a minute. Monthly contributions must be at least $10 per month, but may be more than that, and it's at the agency's discretion. Monthly contributions must continue until the balance reaches $120, and agencies may choose to supplement those contributions with other private and or public funding sources. But the important thing is that monthly contributions must be the same for every household. In general, households cannot access the funds until the savings balance has reached $120. And at that point, the funds can be moved to the participant's bank account and can be used for unrestricted purposes. So agencies may also establish policies that allow households to access the funds for emergencies before they reach $120, but the funds are only released once they reach that threshold, unless it's an emergency and there are some procedures established for that. All right, so through this program, agencies must work with the same households for 24 months and must work to connect participants to banking services as needed. PHAs may choose the number of participants in the program, but must follow a few guidelines to meet the requirements of the research component. And those are that they must assist a minimum of 25 Section 8 or Section 9 assisted households to provide sufficient data for the research component. And the number of participants may not exceed 50% of the PHA's total Section 8 and or Section 9 assisted households. So PHAs must use the cohort specific waiver and the associated activities that are titled Cohort 5.1 opt-out savings account to implement the savings program. And we will discuss this in a minute. All right, so participating public housing agencies will need to request a cohort-specific waiver. You can find the details starting on page 5 of the selection notice. So that's where you can always go back for more information about the program. The waiver authorizes the agency to provide funds to households with the goal of increasing their savings. And here are the main terms of the waiver. So please note that the information on this slide was taken directly from the cohort selection notice, but PHAs have some discretion in how they implement those, some of those terms. So let's take a look at the terms in the selection notice. So again, funds to assisted households must accrue for at least 1 year or until the account balance reaches $120. Once the balance reaches that amount, 120, the funds are accessible to the households without restrictions. Agencies must work with the same households for a full 24-month period, providing at least $10 monthly. What this means is that the funds can continue to accrue past the 120 balance, but there is no limit on how much households can accrue in the account. In addition, households are encouraged to contribute their own savings, but they are not required to. The waiver also states that a contract of participation is not required for this program. And this is important. It's an important distinction from the family self-sufficiency program, where households must opt into an escrow savings account under a contract of participation. Households do not need to meet FSS eligibility requirements in the FSS statute to participate in this program. The waiver also states that all PHHCV assisted households must be eligible, and that is regardless of age or disability status. And in addition, contribution amounts are not tied to income and will be made whether or not there is any corresponding increase in tenant rent. So a little different from FSS, a lot more flexibility there. And finally, the agency must provide the opportunity for households to opt out of this activity. So that is an important feature to keep in mind. You need to include at least this cohort specific waiver in your MTW supplement, but just to be clear, you are also permitted to include other waivers in the supplement if you wish. All right, so now let's turn our attention to a key aspect of the opt-out savings program, which is the type of accounts that agencies will need to establish on behalf of participants and the type of account participants will need to establish to receive the funds after the deposits have reached the $120. We have a little table here that shows us the two types of accounts that will be used during each phase of the program. So we're going to call the first phase of the program the building savings phase. And what that means is that during this phase, PHAs will need to set up an escrow style account to deposit the funds on behalf of assisted households. Again, until the balance in each of those for each of those households reaches $120. Agencies may choose to skip this phase by depositing the amount straight, from the beginning right away. But they can also choose to make those contributions over time. Simultaneously, or as agencies are reaching the end of the building savings phase, agencies must help connect households to banking services as needed and make sure that participants have an active account where they can receive the funds once the $120 have been reached. So we refer to this phase of the program as the savings available phase. So the first phase is while the savings are building, while the funds are building into the escrow account, and then the next phase, the savings available phase, is when the funds can be distributed to participants. So in preparation for the savings available phase, Agencies may share information and resources with participants on what to look for in a bank account. So as they help clients and residents get banked, they may want to establish relationships with financial institutions in the area that they can refer participants to, um, and they can share information with participants to help them be successful in opening those accounts. There are a lot of factors to consider when helping people choose a bank account, and we're going to talk about some of those. But that includes things like um, opening deposit amounts. Those really matter, as well as fees that can eat into the savings. So let's take a look at some of those. All right, so, oh, sorry about that. There you go. Okay, so earlier we discussed that some PHAs may choose to skip the initial building savings phase by depositing the minimum 120 in household accounts right away. The following information on managing the escrow style account will be more relevant to agencies who choose to make regular deposits over time on behalf of households. Agencies who choose to make regular deposits will need to establish an escrow style account. And this is not necessarily a formal escrow account, which can carry restrictions and fees that are not necessary for this program. And the purpose of the escrow style account is mainly that it limits the household's access to the funds as the funds are building to the $120 threshold. So you will note that this is similar to the process used in the Family Self-Sufficiency Program, but under FSS, the accounts have to be formal escrow accounts, which is not the case for the MTW program. And here are some best practices to consider when making regular contributions on behalf of households using an escrow style account. For example, if agencies choose to deposit $10 a month for 12 months. So by establishing an escrow style account, PHAs can retain full control over the account. The account is managed by the agency and recipients don't have access to the funds until those are released. Agencies can set up internal processes or must set up those processes for depositing funds, tracking amounts allocated to households, communicating account balance and other important information to participants, distributing funds into household accounts, and then finally closing down the escrow style account upon program completion. In addition, and in accordance with the program goals, the agency may set guidelines allowing households to access funds in case of an emergency. The agency will need to handle account withdrawals and fund disbursements to participants if they choose to allow early withdrawals. And after the account reaches $120, the agency must give the household unrestricted access to the funds. And this will typically be done by transferring the funds into the household's bank account, which can be a bank account that they already have, or it can be one that the agency helps them establish. If your agency is considering opening a legal escrow account rather than just an escrow style account, you may need to pay attention to whether the account pays interest. So for the most part, escrow accounts are not required to pay interest, but there are certain states that may require them to. So agencies should really check with the bank about the account features and any specific requirements in their state. Again, note that the selection notice does not state specific requirements related to escrow accounts. So this is something that where agencies have some discretion. And finally, throughout this process, communication will be really key to raising household awareness of the savings that is taking place, and as well as the benefits of banking those funds. All right. And that leads me to connecting households to bank accounts. So we also mentioned that one of the goals of the program is to increase the number of households with bank accounts. So agencies may provide education, they can share resources to help participants choose the right product for their situation and needs. This is a really important element because having the right account and managing it correctly will really impact client success with this program. A household can use an existing account or they can open a new account at a bank or credit union of their choice to receive the funds. So let's take a very quick look at some of the household account features to consider. Participants may choose to open a bank account or a credit union account. Funds in most bank accounts are insured by the Federal Deposit Insurance Corporation, as you all know. They are insured up to $250,000, and I say most because not all banks are federally insured. There are some exceptions. And similarly, funds in most credit unions are insured by the National Credit Union Administration, or the NCUA, again up to $250,000. And as I mentioned before, I say most because there are some credit unions that are not insured by the federal government. So those are things to consider when you are establishing those partnerships with financial institutions in your area. One other thing to think about if you are considering, if you or your of the households that participate in the program are considering opening a credit union account, is that credit unions typically have membership restrictions that are based on where individuals live or work or worship. They can also be based on military service or belonging to a particular association. So not all credit unions have open membership rules, and that will be one thing to that you may want to consider. All right, so I am going to pause for a minute because I see, Eva, you wanted me to take a look at the questions in the chat, and I see a lot of them are coming.
Yeah,
Why?
we have a few questions here in the chat. So can we incentivize larger payments for households who attend financial literacy courses?
That is a really great question. So I think we talked about how there's a minimum of 120. There's no limit. You can contribute more if you want. We encourage you to think about the mechanics of how that will happen, and it needs to be equitable. Everyone should receive the same amount. So I think as long as if those if the criteria is met, then yes, the idea of supplementing those funds, I think, is great for participants. So a couple of things to consider. Checking accounts are transactional accounts. They may or may not earn interest and are mainly designed for regular use, deposits, and withdrawal of funds. While savings accounts, on the other hand, are interest-bearing accounts. They are designed for saving money that is not needed immediately. And by accruing interest, the account grows over time. So they generally, the one thing that we want you to be mindful of is that savings accounts and other longer term, savings accounts generally require minimum balances and have limits on the number of withdrawals that are allowed per month. So some key things to consider when shopping for an account will be to look for accounts that have low or no minimum deposit requirements, as well as no costs or fees or very low fees. Some of those common fees are monthly maintenance fees, overdraft fees, account activation, closure, dormancy, inactivity, or low balance fees. Participants will want to pay attention to branch locations, ATM access, and any related fees to using out-of-network ATM machines. And so those are all things that participants will be should be looking at when shopping for bank accounts, and information that may be helpful for your agency staff to know as they work with clients. So we encourage you to take a look at the Bank On National Account Standards. The link is on the slide. It has the key features to look for and sort of guidance on um, on uh, accounts that are beneficial for particularly for individuals with lower incomes. All right, so next, and before we move on to doing some group work, I wanted to talk about the goals of the savings program and the types of accounts that agencies and households will need to establish. So here are some key considerations as you design your program and you set processes in place to implement it. The first consideration is identifying banking partners. Finding the right partner will be where you can refer participants to open low-cost bank accounts will be one of the most important components of the program, as well as establishing multiple partnerships, which will help you refer clients to different places depending on their circumstances. When making referrals, we want you to consider factors like branch locations and access, accounts offered, account fees, customer service, if there's any language barriers, things like that. These are all important elements that will determine your client success. Equally important will be to secure internal buy-in and setting up clear and efficient processes to minimize the administrative burden on your staff. So consider the burden on staff related to setting up and managing the escrow style account, making regular or lump sum deposits, reporting account activity to participants, and arranging transfer of funds to participating households. Also consider any additional outreach and education activities that you may need to engage in to ensure that participants are banked and that they receive the information that they need to help them manage their finances. One thing to note here is agencies may choose to work with community partners to make financial education and financial coaching or counseling available to residents. There's lots of good organizations doing work in that area in most places. And then finally, a couple of considerations that are important. Agencies will need to consider how they will safeguard participant information. So consider resident privacy. PHAs must set up procedures for safeguarding personally identifiable information when collecting personal and financial information from clients. And this includes delegating responsibilities among staff to make sure that only a limited number of people have access to resident PII and that they are adequately trained to handle the data. And finally, agencies will have to consider how and what to communicate to households to ensure their engagement. So think about developing protocols and processes for communicating regularly with participants about their account status if you choose to make deposits over time, or if you choose to make additional deposits or offer incentives. Setting up the clear communication will help you stay on track with account activity and reporting, and make sure that clients are engaged in the program. I will now share some information about resources that can be helpful as you work with participants to get them banked and get them working towards increasing their savings. So we have a couple of screenshots on the next slide. Yeah, there you go. We wanted to show you these resources because most frontline staff are not trained to be financial empowerment experts, and we hear this over and over again. But in this program, they may face questions and at the same time may be in a great position to support residents. And to do that, they will need resources that can help them get comfortable having those conversations. So here are some links that you may want to explore and share with your staff that will be involved in the program. All right, so first we have Money Smart for adults. In particular, we are highlighting here Module 2, called You Can Bank on It. This is a curriculum that was developed by the FDIC, Money Smart for Adults, and is meant to serve anyone who wants to teach or to learn about financial education. It includes participant guides, instructor guides, and PowerPoint slides. And Module 2 in particular covers the general process for opening a savings and checking account, including options for people who initially are not able to open an account at a financial institution. It also covers how to keep costs down and develop positive banking relationships. So really great information to share with your program participants. So that's FDIC Money Smart. Money Smart also has How Money Smart Are You, which is, we don't have a picture on the slide, but it's this resource is a game, and it has other resources that accompany the game that can help consumers create plans to build assets to move into a more solid financial situation. And then we have Your Money, Your Goals resources. And that's the second screenshot that you see, which is a resource by the Consumer Financial Protection Bureau. So Your Money, Your Goals is a set of financial empowerment materials, not a curriculum, a set of tools that organizations can use to help people meet their financial goals by increasing their knowledge, their skills, and providing them with resources. And these materials were designed for use, specifically for use by frontline staff practitioners who work with underserved communities. The tools and information can help people have money conversations with their clients. The materials were specifically designed for people who are not financial experts, but are trusted sources of information in their community. So they are interacting with clients. Your Money, Your Goals includes a variety of resources. It has a toolkit, it's a pretty comprehensive set of tools that practitioners can use. It is not a curriculum. Tools can be used separately as needed. It also includes companion guides to help address the unique needs of people, for example, with disabilities or people who have criminal records. There's a companion guide specifically geared towards Native communities and one for the military community. And then there's a set of booklets that deal with people who, that are basically intended to help people who are falling behind on their bills or that need to deal with debt. There is one on credit and one on savings, and two of those are available in Spanish as well. So just a great set of tools that are intended for people who are not experts to build their knowledge base and to help them be comfortable in having conversations with clients. So if the group would find valuable, we can look at dedicating time in the future, in a future community of practice session, to look at some of these resources in more depth. That's something we can offer and something you can think about. There is a whole suite of these products that we can talk about.
And that concludes our session. We wanted to really thank you for your participation today. I've enjoyed hearing from all of you about where you are in your planning process. I think this gives all of us a great bead on what to talk about next in future community of practice sessions. So please do look out for invitations to those upcoming sessions. And with that, unless colleagues had additional points, we can conclude today's webinar. Allison, any parting words before we break?
No, I didn't have anything additional, just to say thank you to everyone for joining us, and As Ben said, please let us know about future sessions, and I'm sure we'll be in touch soon.